Do you want to build passive income but you don't know where to start? Well, in this episode, we tackle dividend investing once and for all so you can start generating income on your portfolio. Welcome to Get Started Investing, a show where we help you make the most of your money. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. Very excited for this episode. A little daunted by the way you said once and for all.
Yeah.
Very definitive, as if you refuse to talk about this again. I guarantee you we'll speak about dividend investing again. But yeah, look, it is a hot topic of conversation in the Equity Mates community, in the Australian investing community more generally. Australian investors love their dividends, but with interest rates a bit higher at the moment, everyone has been thinking about where they can get income. And so we're going to unpack everything you need to know about income investing and particularly dividend investing today.
Well, Ren, before we jump into it, some very exciting news. This episode is brought to you by our new long-term partner of the show, BetaShares Direct.
That is very exciting. Another reason to be excited for this episode. On the BetaShares Direct platform, you can build your own investing journey with zero brokerage. Now that is a reason to be excited. Yes. On over 300 shares and all ETFs on the ASX. Want a ready-made portfolio?
Yes.
There are 10 to choose from, or you can build your own. Automated investing lets you set, forget, and grow. Bryce, do you want easy tax reporting?
I do.
Do you want performance reporting?
I do.
Or performance reporting? It's all there, and unlike any other investment platform in Australia.
Love it. Well, building wealth your way has never been easier. Search BetaShares Direct and set up your account in minutes. BetaShares Capital Limited is the issuer of BetaShares Direct. You should read the PDS and TMD available at betashares.com.au and consider whether the product is right for you. Investing involves risk. Refer to the PDS for info and other fees and costs.
All right, well, let's get into today's episode. It was sparked by a question from Alice. It came in on the Equity Mates contact form. You can ask your question, equitymates.com/contact, and you can record a voice note there as well. We love your voice notes. Unfortunately, Alice didn't record a voice note, so you have to live with me reading it out. Alice wrote, she's been learning heaps, recently started listening to the podcast, and is interested in focusing on creating a portfolio that can generate her some passive income. From her research, it seems dividends are the way to do this. One problem, she doesn't understand them or how to find ETFs that pay them. She asked if we could do an episode unpacking dividend investing.
Love it. Well, thanks for the question, Alice. So in today, we're going to cover what dividends are, how they're calculated, and how you, understand how much you're actually going to get paid, why dividend investing and who it suits, how to start dividend investing, can ETFs pay dividends, and finally, some of our top picks for stocks and ETFs here in Australia that pay dividends. A lot to get through.
All right, well, let's start at the beginning. What are dividends? Every year, a company makes a profit and they sit around the table and think what they're going to do with it. They might take some of that money and reinvest it in the business. They might decide to hire some more staff. They might pay down some debt that they've got. But there will generally be a part of that profit, a portion of it that they say we should pay out our shareholders for backing us and reward their loyalty to us for all these years. That portion of the profit that they pay out is split evenly amongst all the shares, and it's paid to shareholders as a dividend. So as a shareholder, a dividend is your share of the profit that the company pays out to shareholders.
So good. All you have to do is own the stock and you get profits from it. Now, how are they calculated? So companies will effectively decide with that pool of money that Ren spoke about how much they're going to pay per share. And you'll often hear it in a quarterly or an annual update. Fortescue, BHP, Commonwealth Bank will come out and say, we're paying, $1.56 per share in dividends. And then you can easily sit down and figure out how many shares you have and times it by that number. It's pretty straightforward.
Thank you. I'm glad you explained that in such detail. The other thing to be aware of is dividend yield. You'll hear that term and you'll see it if you Google stock that you own. It's expressed as a percentage. It's calculated by taking dividend per share and dividing it by the share price and expressed as a percentage. It's essentially the payout percentage based on the share price. So if I'm getting $1 per share and the share price is $100, then my dividend yield is 1%. And so the higher dividend yield, the more dividends you're earning for relative to that share price. So sometimes people will chase dividend yields. There's a bit of buyer beware there, but that is what a dividend yield is.
Yeah. So that is what dividends are and how they're calculated. But more importantly is why dividend investing. And there is one key reason that people chase dividends, and it's in Alice's question. It's to build passive income. Pretty straightforward.
So there are a number of assets that pay income: high interest savings accounts, bonds, investment properties. Help me out.
Stocks.
Infrastructure.
Yeah.
Why is it that stocks and dividend-paying stocks favoured by so many people for passive income?
The main reason is here in Australia, there is a favourable tax environment called franking credits that make dividend investing and the income that comes from that very appealing.
Yeah. Now, Australia is one of 3 countries that have full dividend imputation, which is the technical term for franking credits: Australia, New Zealand, and Malta.
Nice.
Bit of trivia for you. Other countries did have it, but have got rid of it. The principle is to avoid double taxation. So a company makes a profit, they pay corporate tax on that profit, and then in most countries, then a portion of that profit gets paid out as dividends, and investors get taxed on those dividends. And so the Australian government has said, well, if there's already tax being paid on that money at the company level, then investors shouldn't pay tax on that at the dividend level as well. And so the company can pay out franking credits, which are essentially tax credits, and you can take that to the tax office and say, hey, tax has already been paid on this, so reduce my taxable income as a result.
Which is why you'll tend to find the closer people get to retirement, and then particularly in retirement years, income is very important. And so you'll find that a lot of investors at that stage in life focus on dividend stocks because it helps to reduce their taxable bill and also gives them some income.
Yeah, well, yeah, highly controversial policy that Bill Shorten tried to take out in 2019 and lost the election, which would stop franking credits being paid out as income to retirees, but separate conversation. I think the important thing to note is that's why Australian companies pay such higher dividends than their peers in the US and Europe. In those countries, stock buybacks are a more tax efficient way to return money to investors, whereas because of our franking credit systems, dividends are a more tax efficient way, or equally tax efficient way. So that's why Aussie stocks love dividends. That's why Aussie investors love dividends.
It's time to chat about how you can fall in love with dividends.
Yeah, and I think it's important to note that whether or not you consider yourself a dividend investor, everyone is a dividend investor to some degree. Like,
big time.
Unless you're only investing in like unprofitable tech companies and small caps, you will get paid dividends. If you own the ASX 200 index, the S&P 500 index, you will get paid distributions and dividends throughout your investing journey. So let's talk about who it's for, but I think in this section, let's keep in mind when we talk about best practice and how you should think about dividends, this applies to everyone. So Bryce, with that clear caveat in mind, what kind of investor does dividend investing suit?
It suits anyone who genuinely wants to build passive income.
Yeah.
That's really the number one sort of bucket. As I said, you tend to find that it definitely weights towards people progressing towards or moving to retirement or in retirement because income is incredibly important at that stage in your life. But if you are that person as well who is trying to pursue FIRE, that financial independence, retire early, you're going to get to a point in your life where you need to be spitting out income from your portfolio. So if you are looking to genuinely have a passive income stream that can help support your lifestyle, then this is who dividends are for.
Yeah, and I think there's an important caveat in what Bryce said, which I think is worth drawing out, which is you will get to a point in your life where you need the income.
Yeah.
Because a lot of people who think about wanting to build passive income or think about financial independence, retire early, which is FIRE, they think about investing in income from day dot. But the way that I think about it is more of a 2-step process. Have the goal and the dream of living off your investments and generating passive income and telling your boss to go and get stuffed. But that doesn't mean buying assets that pay income from day one. It's a 2-step process. The first one is building that portfolio to the point that you need it, generating enough capital growth to then go to step 2, which is optimized for income, and invest in those income producing assets. Thinking about it as a two-step process will get you there faster, because that step one will get your portfolio to the size that you need it faster. And then you can generate income off a larger portfolio. So with that caveat in mind, let's jump into how anyone can start dividend investing.
So as you said earlier, Ren, everyone I think who has a core portfolio is index investing. And I want to put some numbers to that to illustrate your point. The ASX 200 has a distribution of 3.5% a year.
Yeah.
So it's not wild. It's not, the double digits that some products spit out. But the key thing here is you are getting a dividend. Through index investing.
It's not wild, but like if you can get your superannuation to $1 million by the time you retire, 3.5% yield is $35,000 a year.
Well, the leveraged ETFs that I have in the portfolio, for example, GJUS, it's 4.67%.
Yeah.
So still not wild.
People aren't.
But that's US.
People
that's US.
Yeah. So I
guess my point was, if you think you're not dividend investing, you probably are receiving some dividends to start with.
Okay, so what should everyone who's receiving dividends, how should they approach their dividends?
I think if you're not doing it for passive income and you don't need the cash, you should be reinvesting those dividends as fast as possible. And either doing that by a dividend reinvesting program, which you can set up through the same stocks, or actively ensuring that if you get it paid in cash, you're putting it back in the market in another opportunity.
Yeah.
I think having them just sit in a bank account or take them to the pub or whatever is the worst thing that you can be doing. You want to be reinvesting those as fast as possible.
Definitely. So you've kind of answered it. So let's just explicitly answer it here. The one question we got was, can ETFs pay dividends? And as you've just explained with some of those examples, yes.
Yes.
Now, a terminology point of view, we're talking about dividends. And if a company pays you a share of their profits, you'll see it called dividends. When an ETF pays their equivalent of a dividend, you'll often see it called distribution. For our purposes today, dividend distribution means the same thing, cash in your pocket.
So that's the ETF side of things, and we'll get to a couple of our favorites in a moment. But of course, here in Australia, there are stocks that pride themselves on paying healthy, continuous dividends, and you can build portfolios with individual stocks that are known to be long-term dividend-producing companies that don't necessarily have that long-term capital growth that you're looking for, but have consistently paid good dividends. We've actually done a number of segments on the shows. What are they called? Dividend aristocrats?
No, they're in the US.
They're the US ones, yeah. But here in Australia, I think there's 25 odd companies or so that have consistently paid dividends for the odd, last 30 years or so, and haven't reduced them.
I'm sure, yes. I'm sure there are. Washington Soul Patts, which I think is now just Soul Patts, is famous for just continually increasing its dividends. The banks have cut dividends at different times, but they've just been consistent dividend payers. But who you were referring to, Bryce, is the dividend aristocrats, which over in the US are companies in the S&P 500 that have raised their dividends for at least 25 years. And there's 100 companies in the dividend aristocrats. But there are some companies that have been doing it so long that there are now dividend kings.
Oh, wow.
Yeah, which I believe are stocks that have raised their dividends for 50 consecutive years.
Wow.
Yeah. So if you're interested in consistent dividend paying stocks, have a look at the dividend aristocrats and the dividend kings over in the US. The important thing to note is that whilst they continue to increase their dividend yields are still lower than their Aussie peers for all the reasons we spoke about earlier.
Yeah. Now, we'll put a link in the show notes to the Morningstar page that has a list of all the Australian companies and what dividends they're paying. Also, the upcoming dividends that they've announced. For example, Rio Tinto is the leader here in Australia, having announced $3.50 per share.
All right, well, let's close this episode out by talking about some ASX dividend ETFs, some that are specifically designed to generate you income. And I think a really important thing to note here when we're talking about stocks, when we're talking about ETFs and their yields, they're trailing 12-month yields. Now, what do we mean by that? With the way that it's calculated is you look at the dividend or distribution paid over the last 12 months and then divide it by the current share price. So often, if a stock has tanked, their dividend yield will look really juicy because you look at the last 12 months of dividends and then you compare it to today's share price, which is in the toilet. And so that's called a dividend trap. And so you've always got to be a little bit mindful about just looking at dividend yield and investing in those with the highest yields because it is backwards looking, not forwards looking. But with that said, let's have a look at some of the ETFs that are specifically designed to pay income.
Nice. So the number one in Australia at the moment is the Switzer Dividend Growth ETF. The ticker is SWTZ, an active portfolio looking for long-term growth, but also, as Ren said, specifically built with companies that pay dividends. So they'll actively manage that to ensure they're not falling into this dividend trap and they're long-term sustainable dividend payers. It did have a yield of 11.23%. Then there's the BetaShares Australia Top 20 Equity Yield Maximizer Fund. YMAX is the ticker there, 7.5% yield, again set up specifically with companies that pay dividends. Morningstar Australia Moat Income ETF DVDY, 3.3% yield. The Australian Select High Dividend Yield Fund SYI, 4.84% yield. Then there's the Vanguard Australian Shares High Yield ETF, ticker is VHY, a yield of 5%. We did an ETF Explained episode on that. We'll include a link in the show notes if you want to go deep. But I think my takeaway here, Ren, is the yields fall pretty quickly back to what I would consider just your standard boilerplate ASX 200 yield. That, I mean, they're a little bit higher, but if you just invested in the index, you're going to get very close to what these specific funds are spitting out.
Yeah, it's almost like every episode that we do of the podcast goes back to just buy the index.
I know.
But it's because the index is a powerful and elegant thing. Look, I think one other trend that we're seeing come to market, we're seeing a lot of option strategy ETFs that you'll see them called complex ETFs in Australia from now on. A number of them are big distribution payers. There's a number of covered call ETF strategies, which are essentially give up some of the upside on the stock market as it's growing, but can pay a pretty consistent dividend stream. JP Morgan have released a couple. There's a few more coming to market. So you will likely see more of those if you're searching for dividend paying ETFs. Keep in mind they're complex, they're a little bit more risky, they use options, but they have historically been pretty consistent dividend payers as well.
Yeah, they're certainly in the top payers. We'll put a link in the show notes again to a Morningstar resource where you can actually have a look at all of the listed ETFs here in Australia based on their yield, but be wary of that dividend yield trap.
All right, well, that does it for this episode on dividends. Thank you to Alice for the question. A reminder that you can ask your questions at equitymates.com/contact. We would love it if you recorded the voice note that we could play on the show. But Bryce, that's dividends. You said at the top, it's going to be the one and only time we do dividends. Is that what you said?
Once and for all.
Once and for all.
Yeah,
so,
until next week.
So as we wrap up this episode, final dividend takeaways. Give it to us once and for all. What do we need to take away?
The takeaway is if you don't need the passive income now, focus on long-term capital growth. You're going to get dividends anyway if you're invested in the index. Make sure you're reinvesting them as soon as possible. And then once you get to a certain point in your life where you start thinking you need that passive income, then that's the time to start transitioning to passive income stocks.
And one more takeaway that is if you do get paid franking credits, make sure you claim them because they're a tax entitlement that you don't want to leave on the table.
And finally, if you enjoy listening to us, you can watch us on YouTube. We've just set up a new Get Started Investing channel specifically for this show. So just search Get Started Investing in YouTube, or we'll include a link in the show notes. But Ren, that does us. We'll pick it up next week.
Sounds good.